wanted to run through a scenario where you've just had 2 or 3 weeks off, you haven't traded, you had a bit of a trading break, and you're coming back to it with positions flat and just looking to place that first trade to get back into the game after a bit of a layoff. So I always look at dollar yen first. I think dollar yen is a really good indicator of what's going on in the currency markets, mainly because A, it's got the dollar in it, which is the biggest part of the currency market, but B, also at the moment, especially, you've got the Japanese government or the Japanese Ministry of Finance looking to raise interest rates while America is cutting interest rates. So what's going on there with that differential in the interest rate would have more of an impact on this particular currency pair than any other. So I would zoom out and I know you people are all going to be saying, but I'm day trader, but just bear with me. We start off with the monthly and we see that, pretty much from, 2001, so we're talking 2 years, it's pretty much done nothing but go up. So it's fair to say that the long-term trend is upwards. We had this high here. That was the recent high. That was, let me see the number with my old eyes. What is it? Is just shy of 162. So that was the high. A lot of people in the market were expecting, just as an anecdote, the BOJ or the MOF to come and intervene in the dollar at various levels above about 150. 150 was always seen as a pretty good, strong resistance level, and you can see that around there. But the fact that the BOJ and MOF have let it get up to about 162 implies that they're comfortable with it there, because if they weren't, they would have done something about it. So that's where we're at for the economics meeting the fundamentals. On the first thing I would do is draw this trend line in here from this low, and there. So I'm of the school of thought that trend lines don't have to touch exactly, but they have to be pretty close. We've got the original origin there. We've got a touch here, a failure here. So you could almost call that a touch. And this touch here, which came straight back down to the level and bounced straight back up. You can see that it's failed from this high here. So that was a failure high of, and remember, this is still the monthly chart. So that's last month. That's November. Failed. Starting back below at the bottom end of this here. So broadly, I want to try and take long trades, just because, the trend is up until this trend line is broken in my head. So I'd move down to the weekly charts. Have a look at this move here. This has had a bit of a retracement, so we'll look at the Fibonacci on that. I know a lot of my clients look at Fibonacci's, and I'll tell you guys what I say to everyone. Fibonacci works the best in the biggest markets. So my experience is on things like dollar, yen, euro, and gold. Fibonacci works pretty spot on. And gold in particular, the Fibonacci likes the 50% retrace. But we've retraced already so far this month 50% of this big move down. So we've come up, we've broken that up, and we've come back down and found support at about that 50% level. And you can see that was support here as well. And it was mild resistance here too. So we're looking at support levels. We're looking at, we still want to be long. And now coming back down to the dailies, we can see that this is a very sticky sort of level where it's stopped and turned around here as well. I would probably want to trade dollar yen from the long side. So in my head, being flat, I want to come here, and the first thing I want to do after deciding what direction is to decide where my stops are going to be. That is decision number 2 for me. Where are my stops going to be? So this double bottom here seems to be important for the time being. I think a logical place to place stops for any sort of long trade at the minute would be below that level. For me, I usually work with a 2.5 to 1 risk to reward ratio, or reward to risk ratio. So I want to get as close to that stop level, excuse me, as I possibly can, because I'm cheap and I want my stops to be small, and then look to trade the long. Having said that, my target for the long is going to be somewhere shy of this. I don't like trading into highs. Those that I've spoken to on the phone will know that I like to trade breaks of highs, but I don't like to target a break of a high on an existing trade. So for me, I'm going to want to find out what that distance is, work out about 2.5 or maybe even 3 times, and then take the target that level there. And I think, you know what, that level's going to come in at around that 61% retrace rate there. So that's the way that I look at markets in terms of how I want to place trades. The other thing that I always do that, because I do carry trades overnight, I'm not one of those ones that worries about swap fees. I like to look for that kind of swing / middle term trading. I like to look at my trades every morning. If I was flat, would I still want to be in it? So that's kind of the big overview for me. If I was flat, would I be comfortable taking this trade again today? So for me, it's all about little risk and bigger return. So as it's holding above those lows, I'd be comfortable to be long. If it breaks that level, I'd want to reappraise, but that's where I'm at. And then obviously reappraise every morning with, if I'm flat, do I still want to be in this position? As it bounces back up and tests higher, I would increase my stops, as you would have done here if you were lucky enough to get that low. Increase the stops to the swing low levels. I think those swing low levels, pivot areas, are really important. Markets stop there for a reason, so let's respect that reason and understand that if it turned around there before, it'll probably turn around there again, just because that's where, logically, that's where the professional traders like to place their orders. The next one we want to go through is Bitcoin. Now, historically, I don't really look at the Bitcoin against the Aussie dollar. I think the market number for Bitcoin is so out there in the public domain that Bitcoin versus US is kind of the way to go. And just as a I guess an interesting fundamental adjunct to the way that Bitcoin works is that for the last 5 or 6 years, people have been talking about that 100,000 level on BTC US, which it's just failed just below. What's going to happen when it hits 100,000 is that all of those people who are targeting that level are going to have their pending orders become market orders. So they could get filled anywhere on that move down. So there is going to be a massive amount of selling, in my view, as soon as that 100,000 prints. And there are a lot of people who think they're going to get out at 100,000 who aren't, because they're going to get slipped. It's funny that this is a daily, we've had that move up. We've had the consolidation of the move up. Price rejected that consolidation pretty hard and bounced up pretty hard. But we've had these really quiet days now. So what this is, if you think of the market as a spring, and if you push a spring together, it's coiling and it's waiting to explode again. Honestly, looking at this series of higher highs, series of higher lows, it looks like it wants to go higher. I would just be very nervous at that 100,000 level, because it's such a level that people have been talking about for so long and so hard. I think that when it does trigger, there might be a little bit of a reaction. For me, I'm comfortable, again, below this low, being long, but I wouldn't want to target a break of that level. So as price dribbles off and gets closer to this kind of area, I think, it might make sense to take a stab at it. And again, this is the daily chart, so that's a pretty big move. I mean, if you were to get them around here with stops down here and target a move back to even a test of this high, I think that's, that would be a nice way to end the year for most traders. That would be it on the technicals.